Well, we are taking a deeper dive now into the failure of two U.S. banks in just a matter of days. First, California's Silicon Valley Bank, and now Signature Bank. Joining us now is Bill Isaac, former chairman of the Federal Deposit Insurance Corporation. He is now the chairman of Secure Isaac Group. That's a global advisory firm for the financial sector. Hi there, Mr. Isaac. Thank you so much for being here.
Hi, Natalie. Nice to be with you.
Well, let's start with your time as chairman of the FDIC from 1978 to 85, another troubling time when many of the nation's largest regional banks closed. So have the lessons from back then helped today?
We've done a lot of changes since then, but unfortunately, we seem to be repeating a lot of the mistakes of that earlier period.
Now, is there a chance that this latest round of bank failures could lead to new regulations?
I hope it doesn't just lead to new regulations. I hope it leads to, we go back to some of the sound ways of doing business that we've learned in the past. I'll give you an example. This is directly relevant to this. In 1978, when I was first at the FDIC, a bank in Pennsylvania called First Pennsylvania Bank. It was the largest and oldest, not the largest, it was the largest bank in Pennsylvania and the oldest national bank in the country. So it had a great history. And it decided to make bets on interest rates. And it invested heavily in U.S. government bonds, U.S. government bonds fully guaranteed by the U.S. government, issued by the U.S. government, and it thought it was in heaven, I guess. But it didn't think about the fact that we were in a very difficult time in the economy. We had a decade or more of heavy government deficits and very loose monetary policy, and inflation had set in pretty strongly. Paul Volcker became chairman of the Fed, and with instructions from Carter to end inflation. So Paul Volcker went about, he's a great American, did a great job. He went about raising interest rates at the Fed and was very, very serious about it for a long period of time. First Pennsylvania was sitting there with all these long-term fixed rate government bonds at rates that were no longer market rates because the Fed raised rates very substantially. Prime rate went to 21.5%. First Pennsylvania got hit immediately, one of the first banks to get in big trouble. Very similar to SVB and what it was doing. And so anyway, the government decided to bail it out. And the FDIC loaned it money, substantial money, and rescued it from failure. Immediate failure, but we did wind it down. The manager of the bank lost their jobs, the board lost their jobs, and the bank was eventually disappeared. Just all the same stuff that happened at SVB. Why that bank decided to do what it did, I don't know, but it did. SVB, that is. They saw the lesson of First Pennsylvania. Why would they repeat those terrible mistakes? But they did, and now they're gone. And that's not the only one that's gone. There's a couple more that have already gone, and there are probably more that will go. People just seem to forget the lessons of the past, and as they clearly have done here.
And President Biden said earlier this was not a bailout, assuring Americans. What would this have looked like if it was an unregulated financial entity and the FDIC could not step in?
Well, it'd be a bankruptcy, and that would be very painful. Or the government might have found another way to step in. The government did step in some, I think, some unwise ways in the period of 2008, 2010. For example, Lehman was failed, but the government did take over and resolve the bankruptcy. And WAMU, back then, a very large savings bank, failed. The government stepped in and spent money to put that bank inside of J.P. Morgan Chase. So there have been times where the government has stepped in. I don't believe the government's ever going to let the banking system get totally out of control. And just because it's a non-bank doesn't mean they're going to allow that to happen if it's a serious financial institution that could have some impact on the banking system or other financial institutions. The government will step in and take care of things. Hopefully, they do it in a way that's not a bailout, though. They really impose some losses on some people who caused the problems.
And lastly, is this an example of the insurance system working as intended?
It's probably working more aggressively and more broadly than it was intended. The FDIC, when it started, I think it was a $10,000 insurance limit, or $20,000 maybe, and that was almost I don't know, about 90 years ago now. And we increased the limit to 40,000, and then to 100,000, and then 250,000. But even 250,000 doesn't seem to satisfy the people who want bailouts. And I mean, I think that we need to be more careful in bailing out. And when we do more bailout and more aggressively and more far-reaching than we should, we just lead to the next bailout, and the next bailout's probably bigger. So I think we need to find a way to tailor this to a greater extent than we do, and I know we're trying to work on that.
Well, Mr. Isaac, thank you so much for your time as well as your insights. Keep it here on CBS News New York, or head to cbsnews.com for all of the latest information.